Hello traders, welcome to a new video on using the order book and using a volume profile to locate spots of liquidity. On my Patreon, I got a question of how can we use the order book, how can we use volume to spot where many stop loss hunts are likely to occur instead of using price. So on my channel, in my price action volume guide, I talk a lot about how typically when we look at a price chart, and we imagine where are spots of high liquidity, meaning where are spots that many traders had placed stop loss orders and not many limit orders. So typically what I like to look at is a price high, like something like that. And then when price goes just above that price high, that's typically a stop loss on, and price goes in the opposite direction. You can see we had a price low here. Price went just below that low and then bumped right back up and tapped the liquidity of the sellers. The sellers sold, and then the buyers regained interest, and then the sellers regained interest. And you can see other spots. I mean, beautiful stop loss on here. Two of them, in fact, actually. We had a price low right there. Price went just below that low, then went up. Price went just below that low again, and then went up. So these are just looking at price and saying, hey, here's a high, here's a low. We're looking just beyond, and that's where we can place our limit orders because potentially we can get filled at a very good price. But that's not the only way that you can trade against other traders and trade stop losses. So what I want to show to you guys is the Smart DOM, and this is an indicator that looks very complex at first. I know it is not a it's not a friendly looking indicator, but I'm going to walk you guys through what each of these means that I'm showing, what the significance is, and then after that, how to actually craft a strategy out of hunting liquidity. So first, let's talk about what are we looking at. So the settings that I have are, let's do with the easy stuff first. So bid and asks, these are the limit orders to buy in blue. These are the limit orders to sell in red. These are sell current trades. So this column in red is just market sells. This column in green is just market buys. This is price, as you can see by the many prices. And then finally, for the slightly more complex, here I have a volume profile, and this is all of the volume that was traded during the current day. It's in black. The spots that extend more to the left mean they had higher volume. So here was high volume, here was very low volume. And what you can see down here is this is the volume profile of the past day. You don't exactly need to have this set up. You don't need to have the last day volume profile and the present day volume profile, but for this video I wanted to show both. So remember, left is today. This is the volume that has been transacted today, and on the right we have the volume profile of transacted yesterday. Okay. So what's the significance of this? Why do we look at this, and why are we going to have a stop loss hunt / market making kind of approach to this? Well, we need to think about where many traders are likely entering positions and where many traders are likely placing their stop losses. So we know that massive volume likely means that many traders had entered into positions. That's what volume represents. The transfer of volume from longs to shorts, or in a market that doesn't support shorting, from new longs who are buying from old longs. Old longs are selling their positions to new longs. But then in a futures market like FUSD at BitMEX, we have longs and shorts. But we still know that points of high volume mean that many traders had expressed interest and had likely opened positions. And what we can do with this information is it's well known that gaps in the volume profile. So what I mean by that is, and this is kind of subjective, you have to really determine this yourself, but I like to look between two high volume nodes in the volume profile. So what that means is two large points of volume, so here, and really this area down here. Right in between, there was not a lot of volume traded. So this means that many traders had not expressed interest in actually trading at this level. What does that tell us? What's the significance of looking at a price chart and saying, okay, not many traders wanted to trade here? Well, we know that one of two things is likely to occur if traders had not shown interest in these levels before. One, a stop loss hunt. Price goes down. This is between 158 and 157.1. This is the point, right? These points right here. So if I look between those 2 points and I go on a price chart, we can see that 158 was here, and 157.1 was down at that tail. So these two tails, this makes perfect sense actually. These two tails did not have a lot of volume traded. Maybe the whole candlestick had a lot of volume traded, but during the actual tail, from the price of 158 down to 157.1, we just didn't have a lot of trading. What this tells us is that price could just dip in and make a third tail and then go back up, because this is a spot where not many traders had expressed interest and where many stop losses may be. You know, some traders may put their stop losses right here. Some traders may put them down here. And two, the second thing that can happen in points of very high liquidity with just many stop orders but not many limit orders is price can just crash right through this. You know, something like this, where you know, there are these price lows here, but price just, you know, drops very quickly. So that is one thing that you do want to be on the lookout for, to look for gaps in the volume profile to spot points of high liquidity where many stop orders may be and where many traders probably don't want to trade. So what you can do, there are two strategies that you can do to attack this. If you look between the price of 158 and 157.1, you could theoretically layer in limit orders. You could put limit buy orders around these levels, but that is pretty risky, especially if price re-enters this zone and then quickly drops much lower. But if you are confident that price is bullish, then you could layer in limit orders at points of you know, where not much volume had been traded. Or you could wait for price to go down. You could wait for price to enter this area, then judge the reaction of the market, and then buy or just maybe not buy if you don't think that looks good enough. So that's the first strategy in determining, using the volume profile, where a good amount of liquidity is located. What we can also do is look at the past day of trading. And again, this is optional, but if you want to go, you know, above and beyond, you can look for other gaps in the volume profile. And beautifully, between the prices of 167.35 and 166 of the previous day, we did not have a good amount of trading. So 167.35 is here, and that was down to 166. So yeah, so from here to here, we just did not have a lot of trading occur. So typically, remember what I said, typically we're going to see either price cut through this level in a tail kind of like that and then reverses much higher, or two, we're going to see price just crash through that level. Well, what happened during the current day? Actually both. First, we actually saw a beautiful example of where price entered this zone of high liquidity, where, you know, we didn't have a lot of trading in the past, then bounced right back higher. So if you had layered in some limit orders around here, you know, that could have worked well. Especially because it did make a few passes at that before, you know, you would have been in profit probably. However, after it cleared these levels here, price just had a much easier time going lower. It just, you know, boom, went lower like that, then really picked up steam after crossing below 166. So how you would play this is, of course, completely up to you. But this was a spot where not many traders had expressed interest yesterday, and we can see what happened as a result. So that's the first strategy, where we're looking for gaps in the volume profile. The second strategy that we can use is just look for single or double points of very high volume, and then look to trade just beyond those levels. So if I look for just an isolated spot of very high volume, so something like 157, I know that just below 157 there are likely many stop losses. Well, how do I know this? Well, I know that if many traders had entered at 157, well, two things are going to happen. One, any shorts who had entered at 157, okay, just auto-centered, but any shorts who entered at 157 or any longs who had sold, they may be inclined to buy at this level, and we can see that a lot of people had transacted there. So that's going to cause some buying, which is already going to make it more likely that if price goes down to here, it's going to go back up. And two, if price clears this area, it's probably going to tap into a lot of liquidity of lots of traders who just placed their stop losses right below 157. Let's go take a look at the price chart. Beautifully, 157 is right here. And I know that from here to here is probably a spot of very high liquidity, where we're going to see many stop loss orders and really not many limit orders. So price is likely to just quickly move through that area. That could be a price tail, or that could be a high momentum move lower. That depends on your bias, if you're bullish or bearish. If you're bearish, you know, this could be a spot to really pick up a position. If you're bullish, this could be a good spot to pick up a long position. And the remember, the only way that I found that out wasn't by looking at gaps in the volume profile, but just by looking at an isolated high volume point and looking just beyond that point. We can actually look at how this even would have or did perform historically by looking for a point like that. We know that 164.3, and remember, this is the volume profile of yesterday. 164.3 had a large amount of volume. However, this kind of shape isn't really an isolated high volume node, meaning like a singular or a double price point of a very high volume. It seems like there's more of a distribution. I tend to like to look for just, okay, it's about to auto center. Lovely. I'm going to try to scroll back up to my point before it auto centers again. I changed the settings, but it still just feels like auto centering every 2 seconds. Okay, enough of me complaining about that. Yeah, we can see actually we had a pretty high volume point here, and then just a drop off in volume completely from 168 to 167.3. So this is a collection of very high volume. So I wonder what was just below yesterday, what was just below 168 and 167.3. 168 was here. 167.3 was at this low. So yeah, that makes sense. And price did stop loss on that area and this part as well. So basically what I'm talking about here is this part here actually did have a large amount of volume. Because that, I know that many traders had likely entered here. It's just, you can look at the volume profile and see that many traders had likely bought there. Now, I know that if many traders have bought, they probably just put their stop loss just below the low. And look at that. Price went just below the low and then popped higher. And all I did was just look at the previous day of volume. If I look for other isolated points of very, very high volume, let's take a look at 166, because this one really stands out. This was the current day of trading. Now, in 166, I know that just above, I'm saying just above because price is currently below 166. So just above 166, there's probably a good amount of stop losses. And price is likely to just probably just cut through that area. So if I look at 166 during the current day of trading, that was here. So interesting enough, I mean, that's kind of far away from the current price. But we have a large amount of volume being transacted in this area. So one of two things would probably happen. One, this area would act as resistance because 166 had a lot of volume, and high volume points can act as support or resistance. Two, a little bit more sinister, many traders may have put their stop losses just above these points or even just above this price high, in this kind of zone, and price may make a very quick tail up here and then go lower, or price might just burst through this whole area once it passes through 166. So the basic strategy in looking for just a single high volume node, looking for one point of high volume, is finding where many traders had entered, or finding a series of prices where many traders had entered, and then being able to imagine where they probably put their stop loss. Now, those are the two strategies that I wanted to talk about today. There is a third strategy, except this is very short term. This is very short term for BitMEX coins, but for Binance coins, this could work. I mean, for all coins, really, this could work a little bit better. But the basic strategy here is looking for large limit orders. Typically, traders like to place their stop losses just beyond large limit orders. So if there's a large resting, bid wall at 159.25, once price actually is able to cross through that, it's probably going to hit many stop losses because, well, why? Well, because a lot of traders see that this point is acting as natural support. It's going to be hard for price to cross with its current volume. Now, when I know that, I can just put my stop loss one tick below. And if many traders do this, then you're going to have a zone of a lot of liquidity and a lot of stop losses just beyond major order walls. So I can see here as well, at 161.3, there may be a lot of stop losses placed up here, potentially by HFTs and algos who read the order book like that and try to hide behind large walls, or just traders who are just looking at the market. Now that strategy, I think, is a little bit tougher than looking at the volume profile of today and looking at the volume profile of yesterday and being able to imagine where traders have put their stop losses by looking at volume. But it also is a way that you can look at the present bids and the present offers. Now, just to give an example of another way we could do this, I could type in something like, BNB BTC and pull up the order book for that. Yesterday's volume and today's volume. Okay, so it is a wide range of prices, very, very, very wide range of prices. But one thing that I could do here is look for these high volume spots, then imagine that many traders have put their stop losses there. And if it's actually going to show me the current bids and offers, yeah, these are the bids and these are the offers. It just looks really weird right now. But these are the bids that it's reading, and these are the offers that it's reading. Yeah, so perfect. We have a large limit sell wall at this level here. So if price goes just above here, I'd imagine it would have a much easier time and hit many stop buy orders. If I actually look for the order book and look for a large limit buy wall, which is going to be one of these blue down here. Yeah, so something like this. This is a series of orders that are large bids. So I would imagine, okay, did it just auto center on me, or did I go crazy? I think it auto centered on me again. Yeah, so around 3780. So these are rounded values because it's kind of cutting off the last of the values. But did that value just disappear, or am I? Yeah. Okay, 721. No, the value did not disappear. And 719. So just beyond when those large limit buy orders on Binance altcoins or any altcoin actually remain, you may see an accumulation of many stop losses going just below that level. So that what can happen is if this level is pulled or sold through, it just hits all those stop losses. Same here. So many stop losses may be here. Many stop losses may be here as well. And it's interesting that there was actually a very high volume spot right there, right? And then there's also a very, very large bid there. So I would imagine that in this area, this is probably going to act as a reversal area, but I would also imagine that there are many stop losses just below here. Why? Well, because there's so much volume traded here today, and there's a present very large bid, so it's probably just intuitive for many traders to put their stop losses down there. So as you can see, this is not a definite strategy. This is something that's a little bit more intuitive, something that the answers are not obvious. You need to do a study of the volume profile. You need to do a study of the present active large bids, the large limit buy orders, the active study of the large asks, the large offers, the large limit sell orders. And once you start to poke around and see these, I would recommend taking a look at a price chart and then actually seeing where that volume was transacted. And then after that, you can mark up spots of liquidity where you believe that many stop losses were placed. So just to recap, I think just to recap one more time, what we can do is imagine that price is going to have an easier time price is going to have an easier time cutting through levels where not many transactions have occurred. This is the gap strategy, gaps like between here and here, or gaps like between here and here. If not much volume had been traded, then we expect in the future price may cut through those levels very quickly with a price tail. 2, if we're bearish, then this is great because if not many traders had traded here, then there's probably not many limit buy orders, meaning the price is likely to just cut right through that. So that could be a spot where we can just sell more or just let our profits run. And the second strategy is looking for high volume points clustered in an area, and that's likely where many traders had entered. And then you can make an estimation, either if you think they went long just below that point, or if they went short just above that point, where many of them had placed their stop losses. So I think that this can be a very strong strategy if you want to take your stop loss hunting game to the next level. Looking at the DOM and really looking at transacted volume and large limit orders can be a way that you could really discover some things about the market that are not really obvious on just a price and volume chart. All right, that's going to do it for today. In the future, I am going to be doing more videos on ATAS. All you have to do is just suggest them on my Patreon, and we will continue doing them. With that, happy trading.